This is Dave Maddock here, just to do a quick update on all the different changes and things going on with health insurance this year. It's kind of a good time right before the open enrollment or during open enrollment for a lot of companies in the individual market. And then we've got a lot of things going on in the government as far as different changes and updates. So let's get to it. So the agenda today, just kind of review who Maddock and Associates are. I believe most everyone here is clients of ours, but explain that. We're going to talk about health insurance reform and give an update of what's going on, and then also follow up with some trends and kind of updates on what's happening in the marketplace. So Maddock and Associates, we've been in business for over 40 years. We're a broker. We work for our clients, and we really help small to medium-sized companies help them manage their employee benefits, really try to help them run a good, smooth operation with respect to employee benefits, get benefits that the employees value, and then also really help them stay in compliance with the rules and regulations, and then all importantly, help the clients maintain benefits at the best price possible. So doing our market analysis, finding the best programs for all our clients with the different carriers available. So we're really here for our clients, help to resolve claims issues, and so forth. So who Dave Maddock Jr. is? So Dave G, this is Dave Jr. I've graduated from University of Washington. I'm a registered health underwriter. It's somewhat of a degree in employee benefits. Past president of the Washington Association of Health Underwriters, as well as a past member of the Washington Health Plan Finder Advisory Committee. So I stay really involved with all the changes and things that are going on with healthcare reform, mainly so that I can then advise our clients and keep all our clients up to speed with what's going on and any changes and try to help them out the best way possible. So here we're going to dig into the health insurance reform update. So on the current state of PPACA, or people are calling it now just the Affordable Care Act, ACA, also known as Obamacare. So it's alive and well, and not a lot of significant changes right now as far as the law is concerned. When President Trump was elected, there was a promise that Trump, along with a House and Senate that were Republican majorities, that they were going to repeal and replace the law, the ACA. And everyone thought, oh, there's going to be Trump care now. It's going to be a completely different medical system after the election. But so far, the efforts to repeal the Affordable Care Act have pretty much failed. September 27th was the most recent vote they were going to have to repeal ACA, and the Senate canceled the vote due to lack of support. So the main issues with the repeal and replace idea is that essentially that it's easy for the government, or I don't know if it's easy, but the government can give people subsidized health care. I guess it wasn't really easy. It was kind of hard to pass the law, but it's extremely much harder to take away an entitlement like subsidized health care than to give it. So it's easy to say we're going to get rid of this law and everything, but when it comes down to actually voting for a law that's going to take subsidies or benefits away from people, or not allow them to access the free health care or government provided health care that they would have, then all of a sudden it becomes a lot more serious, and a lot of the people that said they were for repeal or replace start to change their mind or back away from that. So that's the biggest thing, I think, is just, it sounds good to get rid of it, but then when it comes down to it and people are going to start losing subsidies, they start calling their senators and their representatives, obviously, and voice their concerns against that. The other main concern is that there doesn't seem to be a clear consensus as far as what's the replacement going to be. So there's a lot of different ideas, and not everybody agreeing on what the replacement should be. So while there might be a majority of, or most Republicans are for repeal, but when it comes to the replacement, they don't all agree, and so it kind of has been the reason why they haven't really passed a law to make this happen. So when it comes to the different options of repeal and replace, there's complete repeal and replace, and that would require 60 votes in the Senate and a majority in the House. There's another way would be to amend the current law, and that would require once again, 60 votes in the Senate and a majority in the House. To get 60 votes in the Senate, you need all the Republicans plus 8 Democrats, and they're just not able to do that. On a lot of these, they're not able to get all the Republicans, so that's why they haven't really done anything. And then the other option is to do piecemeal repeal through reconciliation, and they may be trying to do that, but reconciliation means they don't need the supermajority in the Senate, they just need the 51 votes. But they're limited as far as what they can do. They can only make changes to the law that are based on, that have a direct budget effect. So that's an option, and they may try to do that. So what can be done now? So what they have done some things via regulation. So when they wrote the healthcare law, is a big law, but then a lot of the law just was basic rules, and then there's a whole bunch of regulations to follow up on that. A quick example would be like the new law that passed recently for requiring sick leave in Washington State. It's a pretty simple law. It says for every 40 hours of work, you have to give somebody an hour sick leave. But then everyone starts asking questions. What about overtime? What about someone that is fired and comes back? And then all of a sudden, all these more regulations are written, and they don't have to pass laws for every one of those regulations. So similar thing to healthcare reform. They did the general law, which was pretty huge, but then they went through and wrote huge regulations to get all the details, and that's where the Trump administration has a lot of flexibility. They can change the regulation, change the rules. So a couple things they've done already is they limited the special enrollment periods and require extra documentation. So this is an individual market. When it first came out with the healthcare reform, it was kind of a free-for-all, not totally, but it was really easy for people that opted out to come on, claiming a special enrollment period. They've tightened those down quite a bit, so that generally somebody that doesn't enroll when they're first eligible, or on January 1, they have to wait till next January unless they can really prove a special enrollment period. They've reduced the 90-day grace period for individuals with premium tax credits to 30 days. So that allows insurance companies to terminate people quicker for late payment versus having to pay their claims for 90 days and not get the premium. A couple other things, they've allowed the grandmothering of policies. So certain policies, this didn't really happen in Washington, but they kind of allowed them to continue. They're going to keep doing that. And then they're allowing composite rating for fully insured plans on the group side of things, which has happened. What they haven't done, which we'd like, is if they would review and simplify the 60/55 and 60/56 reporting requirements. So these are the reporting requirements for either self-funded plans or plans with groups of over 50 employees. We're hoping they would eliminate those reporting requirements or greatly simplify them. They just gave the latest release on those reporting requirements, and just minor tweaks. It's basically the same thing as last year. So we're going to continue to have to do that. So anyway, there's some things they can do via regulation, some things that have done via regulation. What happened recently, though, is Trump did pass an executive order. That was on October 13th, so a couple of weeks ago. And the executive order, it was a big headline, and so when I went to research it, it's kind of interesting these days when you look at politics. A lot of times you can't even understand what the actual order was. All you get is a bunch of opinions about the order. And to finally figure out what exactly he did was, take some digging. You could get tons of articles about people and what they think about it, but the interesting thing is what he actually did was not a lot. The executive order directs the Department of Labor, Treasury, and Health and Human Services to consider proposing regulations or revising guidance as a means to improve access, increase choices, and lower costs of healthcare. So what it does is it directs these departments to look into 3 separate things, and it says specifically focus on reinterpreting ERISA, which is a very complicated old law that governs all employee health plans, to expand the availability of association health plans, short-term limited duration insurance policies, and health reimbursement arrangements. So it's good. They're looking at ways to improve access, increase choices, and lower cost. And one of them would be through association health plans, which is something that's very common in Washington State. but not so much throughout the country. And depending on where they go with that, that could essentially allow maybe more options, or allow maybe insurance companies to get around the rules that require you to file plans different in every single state. We don't know. We don't know how much room that the ERISA is going to give them to do those types of things. So also allow short-term policy. So in the individual market, right now, if you wanted to just buy insurance, there are short-term policies, but you can only have them for 90 days. And they're talking about maybe allowing those to go longer. And that would be to help people in between jobs or people that missed the open enrollment period, or just another option for people to get individual insurance. And then the third thing is health reimbursement arrangements. They did pass a law at the end of 2016 to expand those. So I don't know if he's looking to expand them more. But really the key takeaway is, like, the executive order really didn't do anything. It doesn't cause anything to change. What it does do is just directs the departments to research ways to improve access and choices via association health plans, health reimbursement, short-term medical insurance. So we'll just have to keep an eye on it and see what kind of regulations they propose when they come back, and then whether or not those get approved or put into law. And then after that happens, then what kind of products the insurance companies or association health plans, or what we can come up with to take advantage of those regulations. So anyway, it's a ways off is what I'm getting at as far as any actual changes or new products based on this executive order. So just quickly, when you're wondering what, the Republicans basically have majority of the Senate, House, and the presidency. So it's kind of, if you're wondering what might happen with healthcare reform, at least is good to think about what their principles are, what they're trying to get done. Whether or not they can get these things done, or it's a different story. But one thing the Republicans are in favor of is a cap on employer exclusion of health insurance. So right now, health insurance is completely tax deductible for employers. They are actually in favor of putting some sort of cap on that. I know our association is not in favor of that. It kind of penalizes people's expensive plans, but that is one thing they've talked about. Reinstate high-risk pools, and that's I would imagine that probably will happen. In Washington State, we passed a law back in the early 90s, very similar to the Affordable Care Act, and it didn't work, very similar to what's going on now. And there's a point where all the insurance companies pulled out of the market, and the way we got them to come back was within high risk to reinstate high risk pools. And so that's a discussion a lot of people are having about how to revive the individual market after ACA. Another thing they're in favor of is implementing bigger rate bands. So right now in the individual market, for if you're not group, individual, and then a lot of the group plans, the max difference between youngest and oldest is 3 times. So the oldest person in the group can't be, or like a 65-year-old, the oldest age table can't be more than 3 times more than the youngest. And so they want to expand that to 5 to 1. That ends up hurting the older folks, but helping the younger people. And the idea would be to get the younger people to be able to go on the plan and afford the coverage. Create advanced refundable tax credits. So that's in lieu of the exchanges and that kind of thing, would be a way to help people, lower income people, pay for insurance. Cap Medicaid reimbursements at a per beneficiary level. So Medicaid's the insurance for low income people. And, if you're quite low income, you get entitlement called Medicaid. And to control the cost on that, the federal government, the Republicans would like to be able to just tell all the states, hey, we're just going to give you X amount per person that's on Medicaid. Right now, it's a little more open-ended than that, and they have a tough time controlling the cost on that. Establish health plans for small business collectives. That's kind of the association health plan thing that Trump said in the executive order to focus on. Promote use of health savings accounts. And health savings accounts, I know a lot of people have them. They've been around since 2004. It's just the idea of going with a more catastrophic type medical plan and then having a tax advantaged account to pay for your smaller or expenses before you hit your deductible. And then implement medical malpractice or tort reform. So that's always been a talking point. of the Republicans that just always hits a lot of resistance from the lobbies as far as one idea about the rising cost of insurance is that doctors practice defensive medicine or sometimes do more procedures than potentially required because they're worried about getting sued. And then also doctors' costs are high because they have to pay for a lot of malpractice insurance. So one idea is if they could control those lawsuits, that could help limit the amount of defensive medicine, they call it, which is a cost. So that's kind of the goal. When you talk about healthcare, that's pretty much what the Republicans would do if they had, that's their main principles if they had their way. But as far as getting agreement on any one of these issues, it's kind of a case-by-case, step-by-step situation. So another update just on HSAs. So a lot of our groups have health savings accounts. So these are tax advantage bank accounts that you can have if you have a qualified high deductible health plan. So every year they increase the limits of those. So this year, if you're single, they've increased the maximum by $50 from $3,400 to $3,450. And if you're family, they increase the maximum by $150. So that's from $6,750 to $6,900. And then there's a HSA contribution catch-up. So if you're over 55, that stays at $1,000. And then one thing that changes the minimum deductible. So if you have a health savings account medical plan, there's these to have a high deductible health plan, a qualified plan. The deductible now can't be less than $1,350 single or $2,700 family. That's just up from before. Most carriers start their deductibles at $1,500 single or $3,000 family, so this doesn't really impact many people. The only way it would is if you are have an HRA or you're self-insuring part of your HSA deductible, you want to make sure it doesn't kick in until after those IRS minimums. One law that actually was passed at the end of last year, it's called the 21st Century Cures Act. So this was actually something, one of the very few healthcare laws that did pass right at the end of last year. And it creates a new qualified small employer health reimbursement arrangement. So this is a health reimbursement around small employers, so groups under 50 employees, that set aside tax-free money for employees to use to purchase individual plans or reimburse medical expenses. So before they passed this law, it was illegal for a company to give employees tax-free money to buy individual coverage. This does allow people to do that, but it's not quite as good as you think, right off the bat. So one couple limitations is it is for small groups only, groups under 50 employees. They can't offer group coverage to any employees, so they can do group for some employees and this for someone else. They'd have to completely not have a group plan. They must offer the HRA to all employees that work 30 hours a week or more after 90 days, so they're not allowed to limit it to management only or give it to only people that need it. Like people wouldn't opt out. You'd have to give it to everybody, even if that's spouse coverage or Medicare or anything like that. Employees must show proof of payment of individual insurance to get reimbursement, and employer must keep proof. So this would be the idea of an employer say, hey, I just want to give everybody $200 and then go buy their own insurance. I'm not going to do a group plan. So as long as you're under 50 employees and you did not have any group coverage at all, then the employee, you could do that. You could set up this HRA, but the employees would have to prove every single month that they did buy the insurance to get that $200 reimbursement. So there's some mechanisms there to, you'd have to prove it. This is employer money only. So there's no way for the employee to pay. Let's say if you're giving them $200 for insurance and the policy actually costs them $400, they wouldn't be able to put in extra money to pay pre-tax. They would just get the $200 tax-free, and then their other money they'd have to earn would be taxed. And you'd have to give everybody a notice and then report it on the W-2. So the maximums, I don't know why they do this, $49.50 and then $10,000. Why don't they just do $5,000? But it's the government, so that's the maximum you could put in. One of the things to be aware of if you do something like this is that the money that the company gives the employee does impact the employee's subsidy on the exchange. So if you have low-income employees and you're thinking, hey, I'll give them this $200 in my example in the HRA to go buy subsidized insurance, the government already thought about that, and they're like, well, hey, we don't want to, if the employer is paying the person $200, we're going to calculate that into the calculation and account for that. So what could happen sometimes is you could give somebody, a low-income person, this HRA money, and it would just benefit the government, because the government might just see it as like, and let me explain it. So if the HRA contribution makes an individual plan affordable, then the employee may not be eligible for a subsidy. So when they calculate subsidies, if someone doesn't have group plan, like this person wouldn't, and they go in and you get a subsidy if the average price of the second lowest cost silver plan is more than 9.69% of your income. When you give someone an HRA of $200, for example, they have to tell the government, and the government's going to reduce their cost. So the $200 could actually bring them, so it is considered affordable, and then they're not eligible for the subsidy anymore. So it's kind of interesting how that could happen. So maybe without the $200, they get a subsidy from the government, but with the $200, all of a sudden it brings it down under that threshold, and they're not eligible anymore. So there's some other ways it's kind of complicated, where if an employee does qualify for the subsidy, so if that isn't just enough to opt them out of the subsidy, HRA contribution may simply reduce the amount of subsidy, not necessarily help the employee. So they might just factor that in, and all of a sudden they don't give the employee as much as they would otherwise, because they know the employer's giving them the money. So anyway, if you do one of these QSE HRAs, it's important to really educate the employees that they need to tell the government about it. And what we found overall, it's not really a great solution for low-income folks, because it ends up kind of just being a way, a lot of times, that just doesn't really help them all that much. The government wrote the law as such that they're gonna get a piece of that as well, which isn't all bad. What we found is the group coverage is still the best option for most employers, mainly because it's a lot simpler when you do a group plan, and all of the group coverage is tax-free, both what the employer pays, and assuming you have a Section 125 plan, which we do for pretty much everybody, the employee's portion would be tax-free as well. Plus, we're finding that the group plans are just a lot less expensive now than the individual plans. So another thing, just to recap, what's still required is the 6056 reporting. So this is the reporting for groups over 50 employees. So, it's just important if you're on the edge. If you've been over 50, you probably did the reporting last year. It's going to be basically the same thing this next year. If you're growing or bouncing around, they're always looking at your employee count for 2016 to determine if you have to report for 2017. And the reporting for 2017 is going to be due the end of February of 2018. I'm not going to spend, I'll do another webinar like I do every year just to review this whole topic, but basically this is not going away. One thing that did go away is the transitional reinsurance fee. So if you're self-insured, there was an extra tax you were having to pay. That went away. The PCORI fee, this is another fee that hits self-insured plans and also health reimbursement arrangements. That didn't go away. This one's only a couple bucks a person, and you have to pay it generally in July. It won't go away until 2019. So we got a few more months on that one. So that was due the end of July. And so as I mentioned, people that do the PCORI fee are either self-funded, HRA, or FSA. I'll take a quick break, see if we have any questions. Not seeing anything, so great. So I'll check, I'll get questions at the end, but I just want to make sure that nobody was asking anything. So that was my quick update on the health insurance reform. So kind of not a lot going on. I just like to do these periodically because you hear so much in the news about what's going on with the law, and really, like, every day there's another law they're talking about, right? But until they're actually passed or about to be passed, like sitting on the president's desk, then it's kind of just an idea, right? So they're talking about more laws, passing new laws. There's new bills coming through all the time, but we kind of just wait usually until it's really go time. So what I wanted to do now is just talk about the insurance markets themselves. So the individual insurance market is one where that's where you're going to hear a lot on the news. Most of our groups, have group plans. And they get really confused because on the news you're hearing about all these rates going up 20% and all these massive problems. And not to say that the group plan's perfect or group market's perfect, or there's not issues with rising costs, but the big kind of panic and major issues is about that individual market. It's a small market, relatively. Most people get their coverage through group or through Medicare, Medicaid, military, government, something like that. But there still is a big chunk of the population that are self-employed, work for employers that don't offer insurance coverage, or younger people or whatnot that don't get coverage through their employer, and that's what the group market is. And the open enrollment, you'll hear advertised being November 15th through December 15th, or a lot of times in Washington, though, they've extended it a month, so it'd be like November 1st actually until January 15th. So that'd be if anybody doesn't have group coverage, they need to go ahead and enroll during that time period, or usually wait till the following year. The thing in Washington State is the market's not doing so well. The big carrier that a lot of our clients were using, Regents Blue Shield, they have pulled out of Washington State in all but 2 counties, and the 2 counties they're in are like they're pretty small counties in eastern Washington. So, everyone in Kings, Snohomish, Pierce County, Thurston County, no Regents Blue Shield. So a lot of people got letters saying their coverage is gone, and they're going to have to go get other coverage. And we can help them out. We're helping them out, but it's a major disruption. United Healthcare pulled out last year, and many other carriers are limiting the counties they operate in. There's pretty large premium increases. In Washington State, the average increase is 24% in the individual market. You can see here 27. Kaiser, which is formerly Group Health, is the lowest one at 12. They have an HMO limited plan. Molina, Coordinated Care, these are the main carriers. There's a couple more out there, but pretty big increases overall. This is what's going on as far as in 2017, the number of plans, individual plans available per county. So last year, or this current year, there's only one county that just had one plan available. There are quite a few where there's only 2, and then a lot that had 7 or 6. This year it's changed a lot. There's a lot of counties where there's only one plan to choose from. When they first filed the rates, there's 2 counties that were not going to have any insurance carrier, but they were able to, get Primera to change their mind and get back into those markets. It was Grace Harbor and I believe Skamania County. But yeah, there's a lot of areas where you can only have one option. There's a ton where there's only 2 options. So you can see that the number of carriers in the market's just really gone down, and then the premiums have gone up. So it causes problems if you're in one of these carriers plans where there's only one carrier. You kind of have to pay what they want, and then with respect to provider network, you basically have to go to in their network, or there's not another carrier or another network, right? So so that's been really frustrating, trying to help people in those counties get good coverage. The Washington Health Plan Finders, where low-income employees and pretty much everyone now can get pre-funded tax credits, or I'm sorry, just the low-income folks can get pre-funded tax credits, but that most of the carriers are enrolling everybody through that. All the plans now are either HMO-style plans or exclusive or limited provider network plans. And right now, the future does not look too good for the individual market. What you're finding as these rates go up and the options become less is you get the situation where even, more of the healthy people opt out of the coverage. So, people with major medical concerns, you'll generally find a way to keep paying for the medical insurance coverage. But as those premiums go up and up and up, the people that are on that fringe wondering if they should pay it or not. They end up falling off. Those are the healthier ones, and it kind of turns into the spiral. And the main thing that's driven all this is the rules that say they can't discriminate versus pre-existing conditions, and all the benefits they have to offer. I mean, there's also been a lot of the subsidies the insurance companies were supposed to get, the reinsurance payments are not being paid to them. So there's that, but there's overall in general, the concern is, or what's happening is people are able to opt out of the coverage when they're healthy, and then as long as they wait to open enrollment, they can buy it when they need coverage. So people are, tend to be buying it, getting stuff done, dropping it. Sure, they get penalized, but we found that the penalty is not enough to get people to stay insured year-round, and then the subsidies also are not enough to get everybody insured that they need to. So they'll need to figure out the situation. I imagine next year it will continue to go the way it's going. In the small group market in Washington State, there was a lot of turmoil and changes with the affordable health care, but it seems to have stabilized somewhat. The premiums are still going up, but not such a high rate. We're finding Premera, United Healthcare down in the 2 or 0.5, Regents, Kaiser, more in the 5 to 10% range, and Aetna's kind of the outlier up at 39%. So anyway, we found this right now. Regents and Kaiser in the individual market have been pretty competitive. Premera and United have been a little bit higher. With this, they'll probably all be real close. These is just the non-association health plans I'm talking about. If you're part of an association health plan like AWB, BHT, AGC, MBA, any of those type of things, this is not going to apply. These are for the community rated plans. So every year they tweak the plans, and unfortunately, whenever they change the plans, it causes a letter to go out saying your plan's been canceled to all the employees. So that's always a problem. But what we're finding is no huge plan differences. We're seeing similar plans, just different copays and different ideas like that. So what we're finding too is a lot of the groups that may have dropped coverage to go on the individual market maybe a few years ago, they're trying to get back into the group market because the way the group market works, they require that employers pay for most of the insurance, and they require that generally about 75% of the employees enroll, and those requirements stabilize the market. It means in the group market you have pretty much everybody signing up, not just the sick people. They get the healthy people because the employer is paying for most of it. And so while the cost of medicine continues to go up and the cost of these plans go up, they're not subject to the crazy fluctuations or the dire straits we have in the individual market. So anyway, still working with carriers trying to figure out what they can do to keep these medical trend from going up like it is, but not so bad, not as bad as what we're seeing in the individual market. So as I mentioned, with the group insurance, the premiums have been more stable than the individual market. And then the big advantage on the group insurance is the premiums tax-free, both on the employer and the employee side. So that tends to add up to be about a 30% savings in taxes on the group market. Other trends, so that we're seeing a lot of the carriers these days are being more and more flexible about allowing employers to offer more than one plan. And in the old days, when I started, usually like only large companies could offer 2 plans. Now a lot of the carriers allow us, companies down to 5 employees offer 2 plans. Sometimes you can offer 5 or even more plans. So that's been good for the employers that were inclined to want to give employees, hey, here's your money, go buy the plan you want. You can do that. It's called defined contribution. But if you could do it in a group model where you just have one insurance company and you have maybe 2 or 3 or 4 options within that insurance company, and then you can set your contribution. The employees get to choose a plan they want. So that's becoming more and more popular, something that large corporations have always done, but more and more small companies are able to do that. So below, we still have kind of the same main insurance, fully insured carriers in the market. We're seeing more and more of these self-insured or what we're calling ERISA style plans, sometimes people call. These are self-funded plans where generally you have to fill out health questionnaires or they're rating based on your group's health. And so we're seeing All Savers has been popular, Cigna. They're a very large insurance company. They have both fully insured and self-insured plans. And we have Starmark, National General Lifestyles, ATA. So we're seeing more and more of these self-funded options come out with the event of healthcare reform. And as far as a fully insured market, in the group market, Premera, Regents, Kaiser, those are the three dominant. Healthcare, healthcare is dominant nationally, same with Aetna, and then Health Net's a strong regional carrier. I'm trying to think if I forgot any here. I think that's pretty much it in Washington. Association health plans. So this is the AHPs. These are when healthcare reform first passed, there was question about whether they'd survive. There were a bunch of association health plans that went out of the market in 2013. The ones that remain did some changes. A lot of times, most of them changed to a common renewal, not all. And most of them focused on specific industries. But what we're finding is the association health plans are alive and well. We're quoting those for all our groups that qualify. And with the Trump executive order, there's thoughts that might expand. Not sure how it would expand more in Washington, but we'll just keep an eye on that. The association health plans, they tend to be able to discount for groups with better demographics and good health. So groups that are running good get better increase, lower rate increases or no rate increases. But they are able to rate small groups like large groups. So association health plans are able to, you'll see a little bit more volatile premiums. If a group has bad claims, they'll probably get a bigger increase on association plan than they would otherwise. But if they have good claims, maybe less. So anyway, they're a great option for a lot of groups. We've got a lot of business with association health plans, so it's nice to know that they're continuing on. And then, as I mentioned, the self-funded or ERISA plans have become more and more popular. And so I could do a whole subject on this, but the ERISA plans, generally, this is another way for a small group to get around a lot of the healthcare reform rules and regulations. It allows the insurance companies, when you're on a self-funded plan, to rate your group based on your group's health. So a lot of times you have to fill out individual health statements to qualify for these plans. So it's kind of like life insurance. We'll get a quote for a self-funded or ERISA plan, and it'll show the rate for your group's age, but assuming everyone's healthy. And then to get the firm rate, you got to do, unlike life insurance, you don't need a physical. It's just usually health forms, or we have an online website to do that. And then the final rate's based on all the information provided by the employees about the health status. So great option for companies that believe their group's healthy and want to be rated based on the group's health. Also, they get away of some of the taxes, so the insurer fee, the health insurance tax, and some of the specific mandates. So they're not governed as much by the state, somewhat by the state, but ERISA dictates the benefits more, so they don't have to include everything that the state requires, which could be good or bad depending on if you want those benefits. But these have becoming more and more popular. Like the association plans, these can be quite volatile. They look at your claims on a year-to-year basis, and the rates can vary pretty significantly. But a lot of groups are able to save a lot of money as well. If their group's healthy coming in, they can get a nice low rate. And then the self-insured piece is basically when you're paying your premium, a portion of it is for the claims, and the rest of it's usually for admin and stop loss. And then if you're at the end of the year, if your claims are under the amount you paid into the claim fund, then generally you either get a credit or a refund. So that's been a more and more popular. Still a pretty minority group of groups do it, because a lot of groups don't qualify based on their health, but we're seeing these become more and more popular, more carriers offering these options. So that was kind of a quick overview. I wanted to try to keep to 45 minutes. What I'm going to do here is I'll hang out. I've got an hour blocked out for this meeting. So what I'll do is I will take questions if anyone wants to type into the chat. And then if we're good, then we'll just